म्यूचुअल फंड्स सही है, बट कौन सा सही है, किसके लिए सही है? What are mutual funds? Majority of people, what they know maximum about mutual funds are mutual funds are subject to market risk. Please read the offer document carefully before investing. This is the maximum people know about a mutual fund. So in this video, we are going to learn about what are mutual funds, which type of investors need to invest in mutual funds, and how to select a mutual fund. I am going to answer all these questions in this video. So let's start. Chapter number 1, what are mutual funds? Let's take an example to understand. This is Ram. He is inexperienced and doesn't have any knowledge and experience of investing in stock market. There are many people like Ram around us who want to make superior returns but feel stock markets to be scary. Now, mutual funds is an ideal option for such investors. Now, how does this exactly work? Mutual fund companies launch a scheme, say a large cap fund, which will invest money only in the large cap companies. They appoint a fund manager who is an expert as well as an experienced guy in the field of stock markets. Then the company will invite many people like Ram to come and invest their money in this particular fund. Well, this is a great investment option for all people like Ram, as their money will be invested and managed by an expert, thereby increasing their probability of earning higher returns. This is how the entire scheme of mutual fund runs. Chapter number 2. Who should prefer mutual fund for investment? Well, the answer is anybody can invest in mutual funds. But to be more specific, I'll give you 3 types of people who should prefer mutual fund investing. Number 1, the beginner investor. Mutual funds are recommended for those investors who are investing for the first time in the stock markets. As these investors have limited knowledge and experience, they are not able to choose the right stock, which may result into huge losses. In mutual funds, all their investment decisions will be taken by an expert fund manager, thereby reducing the risk of selecting the wrong stock. This allows the beginners to get their money managed by an experienced fund manager, thereby generating good amount of returns for the first time investor. The second category of people who should invest in mutual funds are busy professionals. Mutual funds are an attractive option for those people who are busy with their careers and do not have ample of time to actively manage their investments. The fund manager makes the investment on their behalf based on his expertise and research. This allows the professionals to focus on their career without having to constantly monitor and make investment decisions. The third category of people who should prefer mutual funds are the Evere investors. These are the investors whose priority is safety and want to minimize the risk of loss by picking up the wrong stock. They find mutual funds suitable for their investment goal. Because their money is managed by an expert, plus they are investing in multiple stock, this reduces the risk of loss. This is something called as diversification. Investing in one stock can be risky, but through mutual funds, you are investing in multiple stocks at the same time. So 1 or 2 stocks underperforming is not going to affect your final return on investment. Chapter 3, types of mutual funds. Now I am going to speak about 4 major categories of mutual fund: the equity mutual fund, debt mutual fund, balanced mutual fund, and the ELSS, which is the equity linked savings scheme, or you can also call them as the tax saver funds. First, let us talk about the equity mutual funds. The equity mutual funds invest your money in direct stocks of the companies. The main purpose behind investing in an equity mutual fund is seeing your money grow, that is capital appreciation. Now, under equity mutual funds, we have 3 categories: the large cap mutual funds, the mid cap mutual funds, and the small cap mutual funds. Large cap mutual funds are those funds which invest your money only the large cap companies. Large cap companies are those companies whose market capitalization is 20,000 crore and above. The mid cap mutual fund companies invest your mutual fund in mid cap companies. Mid-cap companies are the ones whose market capitalization is between 5,000 crores to 20,000 crores. And the small cap funds invest your money in the small cap companies whose market cap is less than 5,000 crores. The second category of mutual funds is the debt mutual funds. Debt mutual funds are those funds which invest your money in debt instruments like the government bonds, the corporate bonds, money market instruments and debentures. Compared to equity mutual funds, debt mutual funds are less risky. This is because equity mutual funds invest your money in the equity market where there is going to be high volatility as the stock market fluctuates, whereas debt mutual funds lack volatility and give a fixed return to the investors. Now, no doubt, higher amount of returns can be earned only in equity mutual funds. But again, higher the returns, higher is the amount of risk that you are taking. The third category of mutual funds is the balanced fund or the hybrid funds. This type of funds give the option of diversifying your portfolio, where a part of your money is invested in the equity market and the other part is invested in bonds. This makes the fund less risky and less volatile compared to the equity mutual funds. The fourth category of mutual fund is the equity linked saving scheme. These are also called as the tax saving funds. Biggest advantage of investing in this fund is rupees 1.5 lakh of your investment in this fund becomes tax free. Most of the ELSS schemes come with a lock-in period of 3 years, which means you cannot withdraw your money before completion of 3 years. These are the different types of mutual funds, and you can select these mutual funds based on your investment objective and your risk-taking ability. Very soon, I'll be coming up with a video where I will be discussing in detail about how you can select these mutual funds on the basis of your objective. Chapter number 4, how to select a mutual fund. Now, when you select a mutual fund, number 1, you should know about the company that has launched this mutual fund. Number 2, knowing the historical performance of this mutual fund is also very important. The amount of returns that the fund has generated in the last 1 year, 3 year, 5 year or 10 years is a very important parameter. No doubt, past performance is not a guarantee that the fund will perform the same in the coming future, but still past performance gives you a clear idea about how the fund has been performing till date. The third criteria, knowing the NAV of the fund. NAV is net asset value. It is basically the price of one unit or one share of that mutual fund. Now, the NAV depends upon the prices of the stocks which the mutual fund has invested money into. Now, suppose this mutual fund has invested in 10 companies. And out of these 10, the stock prices of 8 companies go up. Then in that case, the price of our mutual fund will also go up and vice versa. So the NAV is determined by the prices of the stocks in which the mutual fund company has invested your money. The fourth criteria is the expense ratio. The mutual fund company has to incur an expense in order to manage your fund. Expenses include salaries paid to the employees, salaries paid to the fund manager, money given to the research analyst, etc., etc., etc. Now, all these expenses that the company incurs on your fund is being charged from you, from the investor. Say for example, if the expense ratio is 1%, then this 1% of the money will be charged from your total investment that you are making. Say if you are investing 100 rupees, then this 1%, that is 1 rupee, will be charged from your 100 rupees. So practically you invest 100, of which 1 rupee will be expense ratio and remaining 99 rupees will be invested in stocks. Now, ideally speaking, a fund with a lower expense ratio is always a better deal because that increases your final returns on investment. So these are the 4 criteria that you have to follow while selecting a mutual fund. Now, most importantly, start your journey with mutual funds as early as possible. You might be in your 20s or 30s, maybe sick and tired of fixed deposit, cannot afford real estate presently because the initial upfront payment is a big amount, don't know much about stocks, then mutual fund is the best option available for you today. So what are you waiting for? Start your journey soon. So here is Rohan signing off for today. Bye bye. Jai Hind.